right, thanks everybody for joining us tonight. We're gonna do a virtual version of our meetup. So here's the agenda for tonight. So we'll cover COVID-19 and its effect on real estate. Then we'll have an educational series, then a quick update on our Paso deal, and then just open discussion. All right,
Yep.
so
hold up, dude. So before, it's kind of like the rules of engagement. Just 'cause I don't know how many people are gonna jump on, but yeah, if you got a question, we can unmute you, or if you want to make a comment or something like that, we can unmute you and you can ask it, or if you just want to type in the chat box and Matt is gonna just be reading them off. That way it doesn't turn into like because people's internet connections are slow, so it could just like people just walk on each other talking. So cool.
All right. Okay, so for the first segment, COVID-19 and real estate, we'll cover these three topics. So the new underwriting guidance that we've been researching, changes to the financing, and the CARES Act. Okay, so we've been doing a lot of research because we have a deal under contract right now. And so we've been studying up on a lot of operators in the larger multifamily space. And some of the bearish ones said up to a 30% rent collection loss could be expected for the next 3 to 9 months. And so like some of the big names like Neil Bawa, Brad Sumrock. So we've kind of just taken all the different data points from what they expected and kind of aggregate that into our own underwriting and the way that we're expecting things to go in the next couple of quarters. And another assumption is while in the past we could expect rent growth, for the next quarter or two, we're expecting zero rent growth, if maybe even negative, so like down to a negative 10% rent growth. And so principal and interest reserves used to be, this wasn't such a big thing, but now pretty much all the lenders are requiring about 12 months of principal and interest reserves. For the agency lenders, it's even more, 12 to 18 months. And as far as additional income, like RUBS, that's pretty much out the window for at least the short term. So in the next few quarters, we're not expecting any additional income. And that could last 1 to 2 years out. And so what this does is it essentially extends the exit strategy potentially, because it could take a while before we could start implementing our business plan. But with long-term debt, that's kind of how you would mitigate this. So bridge loans are especially dangerous now, especially if you can't extend them. So, all right. And then some lender changes. So like I mentioned earlier, for agency lenders like Fannie Mae and Freddie Mac, they're requiring 12 to 18 months of PITI, so principal, interest, tax, and insurance in reserves. And so what that means is it's frozen.
Put a shirt on, Brian. There's kids here. Sorry.
So you can't actually use this. Like you can't tap this reserve. Like it's just frozen in the escrow account. And the reason they're doing that is because they're expecting this to be a riskier time. So they want to ensure that you have the liquidity to ride it out. And as far as community banks, they're starting to deny loans. They're offering lower LTV and requiring 12 months of principal and interest and reserves frozen escrow account. So this is pretty much what we encountered because we were dealing with community banks mostly on our deal. And bridge lenders, so we attempted to get a loan with the bridge lender as well, like an estimate at least, and then they just pretty much denied it. Like, so a lot of them are putting a moratorium on lending for at least the next 60 days. So those are some new changes in the lending environment. And of course, this has a lot to do with how deals will be played out in the next quarter or two as well, because the lending affects the amount that you need to raise and the underwriting. So
yeah, for Brian's question, the previous reserve requirements. So at like community level, like it's like 2 or 3 months. So a lot of it's based off your DSCR. So how stable the property is. Just going into the bank's underwriting drives most of that. But like for community banks, like the last 2 deals we've done were 2 months. So 2 months of pay what was a requirement and went from 2 to 12 pretty much overnight. Cool.
You got it. All right. So obviously with that and the banks, you know, kind of tightening up because of all of the instability in the market. You know, obviously some of I'm sure you guys as business owners, investors, and anybody who's really been watching the news is kind of seeing some of the different things that the administration has put into play. Part of it, most significant thing, really just being that CARES Act. Now there's been a ton of changes, especially with how, you know, the SBA and kind of the banks and the lenders and whatnot have been responding to this. But, you know, as a base, they implemented a few different programs, one being, you know, the PPP, the Paycheck Protection Program, you know, through the CARES Act, and the other one being the EIDL, I'm drawing a blank on the acronym right now, but the disaster loan. So some of the challenges, yeah, there you go. Sorry. Yeah, so some of the challenges, you know, specifically with the PPP was that you had to have payroll, right? So that was kind of a challenge for a lot of independent contractors and self-employed. And then the max loan was going to be 2.5 times the average monthly payroll from 2019. So in these ones too, you also had to apply through an approved bank or credit union. And I'm sure you guys had seen, you know, a lot of the bigger banks were delayed in rolling this out, you know, overwhelmed by applications. They really just weren't set up to be able to get this money out as quickly as possible. So I know that's created a lot of different challenges for a lot of people. So something else with the EIDL, you know, initially it was, hey, free $10,000, right? I'm sure you guys heard of that. I mean, we've gone through this process ourselves with, you know, on the investment side, on our investment group through TG. But, you know, initially it was, hey, you know, it's just $10,000. It's a forgivable grant, a forgivable loan. But obviously it's no longer available. And then, you know, of course, SBA with some of the changes they were getting through, the overwhelming flood of applications, that boiled down to basically $1,000 per employee. And you had to go through, you know, you're applying to the SBA, but, you know, again, whole set of challenges with that. You know, and you see that here, where how that affected the real estate owners is, you know, you had to have payroll. EIDL was maybe applicable to you. And, you know, like I said, the execution was just, they weren't set up for it. So a lot of that, I think, has still been very clunky in terms of the implementation. Next slide there, Dee. All right, let me get this off of my screen here. Sorry, guys. Okay, there we go. So this was something that was significant, and I don't know if you guys had looked up any of this, but one of the things that they had kind of implemented to help out business owners through the real estate taxes was allowing you to go back more years than you would previously, with 5 years for the net operating losses. So this could help you to go, you know, let's say you had some losses that could be carried back to count against some of the income. Maybe you had some high income a few years back that might help you, that you could qualify some of the losses that you may have incurred through your business to go back and get, you know, through an amended return, you could go back and get some income through this. So that could be a side way that you can go back and get some money as a business owner that could be pretty substantial depending on kind of what your income and your losses are. These qualified, the QIP, you know, qualify as bonus depreciation, the qualified improved property, interest deductions, you know, they increased it to 50%. You know, excess business loss limitation, you know, for 2018, 2019, and 2020 were suspended. So, you know, again, these are significant improvements on the taxes that, you know, hey, this is not catching necessarily all of the headlines, but could have a significant impact for people's businesses and income, and just helping out through liquidity for this time.
Yeah, for the net operating loss, that's something we did. Immediately called our CPA on that, and that's probably the biggest win for me out of this whole process, because I don't qualify for PPP. Probably not going to get the EIDL, but I was able to because we did cost segregation, so I have huge losses last year from a cost seg that we did on the 52 unit. So it was like, I don't know, $75,000 in losses, somewhere around there, that I was able to carry back through previous returns. So after the big wave of 2019 returns, he's going to go back in and file amendments for 2018, and maybe even 2017, I think, if I can, to maximize my, like Steve said, the liquidity now. So I'll be getting a return off of those amendments. So I think that was a pretty big win for us.
Yeah, for sure. So, for some of you guys that may not have been aware of that, I mean, look into it, follow up with your CPA or whoever, you get tax advice from, and see if that's something that could work for, for you. So next slide, please. So this was something that's pretty significant as well. So, obviously you guys you may be aware, retirement accounts, you're usually going to get whacked with an early penalty. And then also, of course, tax on, any early withdrawals. But, what they allowed was up to $100,000 to be tax-free, penalty-free for 3 years. Now, you'll have to, repay that. But, that could definitely be something substantial to help out with liquidity during this time. So, that could free up some capital that, hey, you could still get in on a deal, or if you need it just for, business expenses during this time, then obviously that could be a huge help. And that's, the note there was it's mostly self-certified. So it's not something that that they're putting in, maybe strong, checks and balances in on that one. Not qualified, hardship loans against a 401k, the max was increased to $100,000. And all of these are substantial too, because previously, you would only have to, the qualifying events might be, hey, this is a first-time purchase for a home, or I think some of the other ones are I don't know if it was birth of a child, or for school loans, that kind of deal. So being able to draw out tax-free was significant. And then this last bullet point here, the opportunity to shift funds from more volatile assets like stocks, which, if any of you guys have stock positions, you've seen a ton of volatility. Your accounts have been whacked pretty bad, I'm sure, like mine, the last few weeks. So, this could help, help you get move some funds around to get to something a little bit more stable. So that could be a big benefit. So just making sure, our goal here is just to make sure that the different options available to you.
Right on. Brian has another question. It is, what is excess business loss, or is there a previous cap? I don't think there's a cap. So let me see. Excess business loss limitations for 2018, 19, 20. I don't know. So usually it's like you can take a loss. Like for me, I can't take a loss under 0. So if my taxes were already at 0, then I can't take a loss against that. But if I used up all my depreciation, paper write-offs, and then that was my marginal tax rate, and that's what I pay. But using the net operating loss, I can go back and reduce that marginal tax rate even further. I don't know about the excess business loss limitation. I'll have to get back to you on that one.
Okay.
Matt.
Oh wait.
Screen hasn't changed.
Are you doing the COVID stuff, Matt?
The resources.
Yeah, my screen hasn't changed. Has it changed for you?
Yeah.
Yeah, I'm at COVID.
Okay, well, you guys can see it. There you go. Here I am. So here's just some resources that we've been using kind of as we go through this whole process to track coronavirus and its impact on specifically apartments. So this first one is resources for all the different programs to business owners. Next slide.
Can you see it, Matt?
It's lagging a little bit. But if this slides up, so this next slide is going to be everything that really gives us kind of statistics that we need to make decisions as we move forward. We will be seeing this out, so you'll be able to check them all out. The big one is this bottom one, coronavirus impact on real estate. Neil Bawa put together this website, and it's pretty much a one-stop shop for tracking the effect of coronavirus on apartments, as well as the different countries and their statistics. And the big takeaway from that is right now it looks like we're down from 33% daily growth rate to about 5% daily growth rate. So I hope all signs point towards kind of flattening that curve. Yeah, this is it right here.
Yeah, and if you've been following Neil Bawa's data.
So you'll look at this: United States, Italy, Spain, Philippines, Iran, United Kingdom, Germany, France. Go ahead. We're a little bit behind, I think, each other, but this kind of shows that we're calm with other countries now. We get the current 5% daily growth, 3%. You know, we're head up at the other countries, flattening the curve.
Yeah, and if you've been following Neil, like during this phase when the U.S. daily growth rate was in the 30s, he was especially bearish, and he was basically saying the apocalypse is upon us. And then as this dropped, like his outlook became more and more bullish. So yeah, I mean, it just shows that the social distancing does work, and you know our daily growth rate is going down. So it's hope for you know a recovery somewhat soon. All right. Okay, Vince, you want to take over screen share now?
Yeah. Let me get here. All right. Share screen. All right, you guys see that?
Yep.
All right, I think we were at somewhere.
Educational series.
There we are. All right, so before we get into the education series, biggest thing on like recapping of kind of where we are and what my thought process is as a buyer, because we are still looking to buy even through this, is one, we have to plan for lending. So with the lending requirements, and I did a short clip on this a little bit earlier, is they're probably not going to ease up on those reserve requirements anytime soon. So we have to plan if you're raising money for deals, or if you're going in on your own, you're going to have to plan to raise that 12 months of additional capital that you weren't planning on before, and knowing that it's just going to be sitting in an account somewhere, you know, in an impounded escrow account. So plan for that. What it's going to do to your number, and you're going to have to be able to understand what it's going to do to your numbers, because at first it's going to dilute your returns, your cash on cash returns, because you have, you know, X amount of thousands of dollars sitting in an account that's not earning, it's not working for you. So your overall project level returns are going to be lower. You're going to get it back at if you meet. So what's going to happen is bank's going to say, we want 12 months reserves. It's going to be impounded, and if you reach this DSCR milestone for X amount of time, 2 or 3 months, or a couple quarters, then we'll release those funds back to you. That's what's going to happen. So you have a DSCR limit or milestone you have to reach, and you'll get all those funds back all at once, and it'll be great. And then you can go put them to work. So you just have to plan on ways that you're going to be able to use those funds later, or keep the cash on cash higher. So there's just different strategies. Like one, for us, I asked for our bank, if they can put those funds to work in like some kind of CD, money market account or something like that. That way it's doing something. It's maybe at least keeping up with inflation. It's doing something is better than nothing. So they said they were willing to do that. So that's awesome. Another thing we're going to do, is figure out, have a plan for that money when it's out. We're going to end up using it for like CapEx and stuff like that. And we just rearranged our business plan so we can utilize that money once it's out, but it's not impacting our working capital now, and further diluting our return. So that's one bit on that. And then the other side of it with the whole Corona thing is a lot of people scared right now. There's a lot of owners that are going to be selling their properties, their assets, either out of fear that we're going into a recession, or that they were just unprepared. They didn't have the reserves to weather, a sustained 30% economic vacancy increase overnight, that they just weren't prepared for it. So they're just going to dry up, run out of capital, and have to sell their properties before they go bankrupt. So there is going to be opportunities in this. A lot of people are thinking maybe Q3, Q4. That's what we're looking at. So we are still buying even through this. We're going to be looking out for opportunities as less sophisticated investors need to sell their property. Cool. That is pretty much our plan. Education series. So recap of last month. We're going to go over just some easy stuff here, reviewing OMs, some underwriting documents, and submitting an LOI. So anybody that's kind of done deals before, it's going to be a breeze for you. If you haven't, this will take some of the mystery out of these if you haven't done commercial deals before. All right. So education recap. So last time we talked about selecting a market, conducting research. One of the things I'm going to, how do I exit this? There it is. I've been creating this document, and one of the things I want to make sure that you do when you're creating a system for selecting a market, you want to make it consistent and repeatable and objective as possible. That way you're looking at each property in the same lens. You're not just being biased or subjective towards certain markets, and it's skewing your decision-making process when you're reviewing, when you're investigating markets. So one thing I've been working on is, all right, can you guys see that? Yes, no?
Yep.
Okay. So I've been creating this thing, and it's just a screener tool. So I create everything in a tier system. So I merged a couple different people's tools kind of together, or their philosophy on market research. So I took some stuff from Joe Fairless, some stuff from Neil Bawa, some stuff from Wilbur Profit, Shake and Genome, kind of merged it into a product that I like, and I'm building it right now, so it's not finished. But you pick the market name here, all the major, so the tier 1 is going to be like your major KPIs of that market: population growth, job growth, median household income growth, and median home price. Go down to tier 2 things like who the top industries are, how many Fortune 500 companies, who the top employers are, housing, like what's the average mortgage payment, average rent. That way you can calculate the opportunity cost, percent of renters in the market, crime rate for that market. Going to tier 3, you start talking about diversity, quality of life, stability, and then you go down a little bit deeper to cap rates, cost per unit, stuff like that. And when we're in tier 3, and then you find out if it's a landlord or tenant-friendly market. So I think this is going to be pretty cool. One thing I did was I embedded the links to all these websites that I use in there. So if I want population, I just click on population and it'll go to citydata.com. If I want jobs, it'll go to bls.gov. Same thing, median household income, city data. So all the main websites I use are in here. I just embedded them as a link. So I can send this one out whenever I'm done with it. But the point of that is to create a system and a process. That way you do it the same way every single time. That's the idea. And you can use this, you can create your own. Like I made this in probably, 40 minutes. I've got this far. So you should definitely have a process for how you're screening markets, investigating markets. All right, back to this. Something here. All right. So who needs to be on your core team? We talked about that. It was your agent, property manager, and some kind of colleague, boots on the ground if you're out of state. Like most of us are going to be out of state or out of the area. So you want somebody in that market who you know, who you trust to be on your core team. All right. Brokers, where to find brokers. The easiest way I find brokers is, well, you can just Google it. You go to websites like LoopNet, not like look at the properties, but look who's listing those properties, backfeed into wherever. So you see property on there, you find out who listing agent is, go to their website, enroll into their website. You have to create a login usually. And then now you can get on their drip campaigns at that brokerage. There's a lot of national ones. So you get on the national ones like CBRE, stuff like that, SVN, or you what's the other one? Gray Steel, stuff like that. Or you can get on a more local brokerage. Biggest thing is just find wherever that listing service is and then track them back to wherever their brokerage website is. And that's how you're going to start filling the top of your funnel. We'll talk about when to reach out. I think a lot of newer people reach out too early. When they're looking for brokers, they want to build those broker relationships. You really want to wait until you're like an expert at that market before you start reaching out to brokers. Because if you don't even know, where like the path of progress is, what the different neighborhoods are in a town, or just like basic data, like what units trade for, what a C-class property in that area trades for. You're not going to have a whole lot of credibility, and they're gonna smell the newness on you. So do as much research as you can before you start reaching out to brokers, and you want to be able to have an intelligent conversation with them, and show that you've done your due diligence on that market and you know what you're talking about, and you can speak a lot of the jargon. Okay. Any questions yet? I'm not watching the chat box. All right. Going on. Okay. Reviewing and offering memorandum. Easy stuff. So pretty much we're going to skim through this. What to dump and what to take away. So for me, I usually dump their pro forma, their 5-year projections, and any kind of value add recommendations they have. I normally don't even look at it because it's super overinflated, not realistic, and everything's painted like super rosy. Like they'll have like, paint this for $900 in CapEx, you can get an extra $200 in rent. All right. So they'll have like stuff like that. Completely unrealistic. So I usually dump the pro forma, dump the value add. I'll keep things I do like is their market research, their comps, and the property details. And that's what I really like about a property. I think we have a sample. OM here. So this is one from Texas. So it's an OM, so you can just kind of skim through here. Say, has their value add and stuff like that. Like you're going to get $75 a month for a storage unit. Like they have no idea. They might, I don't know. Usually it's not realistic. So I like the property details over here, what the size is, how old, what's the vintage, is that flat roofs like this? What's the HVAC? What are the utilities split? All that stuff's good. Just the basic background of the property, all the construction stuff. You get a lot of information for that. This is what I really like about OMs is that a lot of brokerages, a lot of reputable brokerages have a lot of good data. So you can definitely shorten your learning curve on learning a new market by getting your hands on a couple OMs from brokers and just reading through what they are putting out there for why this is a good market and why it's up and coming. So they'll do a lot of this research for you. So you can read through here, see what, all the best stuff about, this is El Paso, 70 Fortune 500 companies is something you always hear about El Paso. Good unemployment rate. That's, okay, I guess. Yep, more local stuff, some economic highlights, some new development that's going in. normally you'd have to go, you're gonna have to scour the internet, look up local, chamber of commerce, local news stations and stuff like that to find this stuff. They do a lot of this for you. So I like getting these, and then you go out down to the comp. So or was that at schools, or that's employers? Demographics are pretty good. Yeah, now I like the comps. So all this comps is where, and then I go down to these comps. I kind of like the comps. You can get a lot of good information about this. And then the financial analysis, you can pretty much, I don't know. I don't put a lot of stake in this. Like this is their pro forma, even their T3, probably not that realistic. Yeah, I don't put a whole lot of stake in that. 5-year cash flow, don't really put any weight on this. I just build my own. Right. So those are pretty much how I look at an OM. Best thing to do is just get your hands on a bunch of these. Go to those brokerage sites, sign up, get on their drip campaigns. That way you can start getting these OMs, and you can start getting familiar with the market, and you'll start seeing trends on, every OM, they kind of tout this part of town or that part of town, and or their comps of what units are trading for in that market. But just don't believe their pro formas or their projections. Always do it on your own. Is there a chat? I don't know
Keep going.
that is.
That was just, I just responded to Brian, but keep going.
Oh, okay. So that's the OM. Okay. What else we got? Okay, critical underwriting documents. So whenever you start underwriting commercial property, these are the 2 documents you ask for every single time. Doesn't matter. These are the 2 most important documents, the T12 and the rent roll. So T12 is just your trailing 12 months of income and expenses, and your rent roll is the schedule, your schedule of rents, leases, and occupancy levels. Some, depending on the system, it generates the report. Sometimes it has the history of rents being paid, and sometimes it doesn't. Like if you're using like AppFolio or something like that, a lot of times it won't say the history of like how many people paid per month. It'll just show like a snapshot of it today. If you get it from like AppFolio or Yardi, I can show you examples of those, and these are going to be the ones you ask every time. So you get an OM. If you're even slightly interested in the property, this is what you ask the broker for or the agent for. Got them pulled up. All right. So this is my rent roll from last year. So property, has the leases, the rents in here, and then it depends on, like I said, what system it comes out. You can see who paid and for each month. So you can kind of calculate what the economic, your economic vacancy that way. Biggest thing for leases, you want to see how many are on month to month, how many are going to be expiring soon. If you get this property under contract, how many of them are going to be, expiring those first couple months. That's going to be a lot of work you're going to have to do as soon as you take over a property. If you have, half the places on month to month, or half of them are going to be expiring, lease is going to be expiring really quickly. Just as operations of taking over in lease management, that's something you need to be cognizant of. Rent, you got to see, just pretty much just see what they're getting for rent. Does that hold up to what your research in the market is? Are they getting market rents? Are they undervalued? Is there a value play there, being able to do something and raise rents? So if you're a value add investor, you got to figure out what you have to do to raise the rents up to market. Or if they are at market, then you just have to know that, okay, I'm buying this place at retail, essentially. All right. And then just some reports, like I said, will have rents paid and other ones don't. And that'll give you, calculate that up. It'll give you your economic vacancy. And then you just bump that against the income on this sheet here, which is this is what a T12 looks like. So it's trailing 12 months of profit and loss. So my income for each property. And this is the T12 that matches that rent roll and all the expenses. So you're going to go through here and make sure the income matches the rent roll. And then the expenses, you kind of just want to see, you know, what their expenses are. You should have a pretty good idea of what expenses are in this market. That way you can look at it at a lens of how efficient they are as operators, as managing this property, and then also be able to identify the opportunities. And that just comes with seeing a lot of these and doing your market research. If you know that they're not getting, you know, if their utilities are high, their water bill's high, and they're not getting any additional income from it, then there might be an opportunity to do a water bill back or rub on that. Or if their property management fees, you calculate these out and the property management fees might be like 12%, and you know that you can negotiate maybe an 8% or something like that. So those are the ways you're gonna be looking at that. A lot of ones is maintenance repairs. Usually it's a lot lower than what it should be. A lot of landlords just don't keep up with maintenance, and they might try to tell like, oh, look how efficient this property is. And you're like, nah, it's not really efficient. You're just kind of just not fixing anything. All right. So you got to know what the maintenance repair for that asset is. So if it's a C-class property built in the 70s versus, you know, a B- property built in like the, you know, mid 80s, one has a flat roof, one has a pitch roof, one's in the north where it snows, one's in the south where it might have termites and something like that. During your market research, you'll know like what the typical maintenance repairs are for that class asset in that market. That's why your market research, you shouldn't skip it. You shouldn't skip anything on that. Ask as many people as you can, reach out to property managers and maybe ask some of these things. Because you really want to zone in on what an expense per door is the number you're looking for. So expense per door for the asset class you're looking for. And once you kind of get a good envelope of, you know, maybe the floor might be $3,400 a year and the high might be, you know, $4,200 a year for the property that you're looking for, you know, that envelope, you can look at T12s very quickly and figure out if this property is operating efficient or not. You know, if they're operating at, you know, $5,000 a door a year, that's a big opportunity for you. So like, I know that, you know, these properties, I can get those expenses down to, you know, $3,500 a door or $3,800 a door, whatever it is. And they're at like $5,000 a door. So that'll be a huge opportunity for you to bring those expenses down. And then on the other side of it, if you know it's, you know, $3,800 a door a year in expenses, and you add up all their rent roll and they're operating at, you know, $2,400 a door, you know that there's going to be like a lot of deferred maintenance. They're skipping a lot of stuff. So you have to, me and Duke we call it normalizing. So we have to normalize the expenses because they're going to try to sell you on like, oh, look, this, you know, here's the NOI number, which that boils down to is, you know, if your expenses are light, your NOI is going to be much higher. And that's what the property value gets calculated off of, is the NOI. So you guys like, no. Like, I know you're saying that this property operates at $3,200 a door, but I know that this property, this class property in this market is around a $3,800 a door expense area. So once you plug that in there, like the NOI is really going to be this, and that's what I can offer on. So have the data tell that story for you. So you use their income numbers and then create your own expense is the way that we underwrite. All right. Cool. Any questions on that? So rent roll, you verify this against their income, make sure that they're actually getting the income that the rent roll says it's getting. And then you look at their expenses and you try to find the opportunities to create a better, more efficient management. All right. That's the value add on that. All right. What else we got? All right. So you did that. You got the OM, you looked at the T12, you got the rent roll, and you're going to submit an LOI. So an LOI, if you're not familiar with the commercial property, is just a letter of intent. It's an offer that's not legally binding. So it's not a purchase and sale agreement like you normally see in like residential. It's normally one page, and it just lists the big rocks of what your offer is, because a lot of these contracts can get very lengthy. A lot of that legalese in there, so it takes all that legal stuff out, and you're just going to have the big rocks, which is normally the price, how you're going to finance it, how much EMD you're going to put down, and your time frame to close. Are you going to do a 60-day close, a 90-day close, with a 45-day due diligence, and that's pretty much it. So really basic document. Biggest thing on that is it's not binding. It's just just putting your offer out there. The biggest thing with LOIs, or just putting offers in general, is a lot of people that see like they're not on the same page with their agent. So if you're being represented, make sure your agent's on the same page with you of your strategy. If your strategy is to go in and just like firebomb a whole neighborhood with lowball offers, and like, if I do 100 of them, I might get one or two or whatever under contract, or 10 under contract, and close on one of them. Like, if that's your strategy, am I frozen?
Are you good?
Yeah, no, you're good.
Okay, never mind. I got a text. I was like, man, did I freak? Yeah, so if that's your strategy, make sure your agent's on board with that. You don't want to get to a point where you start submitting like low offers or something like that, and they're like, I don't want to submit lowball offers, and then now you have you're not in alignment with your agent. So make sure your agent, if you're being represented, is on the same page as you, and will do your strategy, whatever your strategy is. The next one is the most important one on this page is, if you're dealing with, again, commercial properties, you're normally not being represented. You're normally going straight to the listing agent or the brokerage that has that listing. So you pulled an OM, you're going to do an LOI, call them first. Like, if you're going to submit an offer, pick up the phone, call the agent, and let them know what you plan on offering. Because again, we're trying to build relationships with brokers. And if you're going to go and submit this lowball offer, and this is the first time you're dealing with this broker, and you're like, whatever, 100 grand off, or say you're at 70% asking price or 60% asking price or something crazy like that, that's going to really start your relationship with them off on a really rocky road, because they're going to submit it. They're like, well, if you send me an offer, I'm going to submit it to the seller. But what's that look like to them actually having to submit, the super unrealistic offer to the seller, and then the seller's going to get mad at the broker, and the broker's going to be like, this guy or girl is just wasting everybody's time. So the best way to do that is just call the broker first and say, hey, this is where my numbers have got me at. Like, this is where I'm at. Should I even write an offer? Am I even in the right, am I even in the ballpark? And then they'll tell you right there, like, nah, you're not. They're not even gonna look at that. It's like, okay, well, if they want to entertain it, let me know. My offer will stand for X amount of days or whatever, if you want to put a deadline on it. But what you don't want to do is make them just submit a crazy low offer and then make them have to go to the sellers, and just that's not good for anybody, and it's not going to build your relationship if you're trying to build a relationship with that broker. Again, commercial is a little different than residential. All right, I think, is that it for me?
Yep.
Yeah. Okay. So trade it back to you.
Sure.
All right.
Okay, so next segment is the update on our deal, La Puerta del Sol. We are under contract, should be closing tomorrow. So for the investors, they're on this call. Sorry for the redundancy. We covered this already in our investor update, but this is kind of educational for everybody else. So these were the initial assumptions that we had coming in to the deal pre-COVID. We had 83% occupancy. After talking to our property manager, we were able to push that up to 87.5, mainly because he's confident he's able to fill the vacant units. And then the rent collection loss, initially we had at 2%, that's historical for the area. But due to COVID, we're expecting it to be a lot higher, like around 20%. So the breakdown is we're expecting about 30% rent collection loss. Now, this is like kind of worst case, right? Like, so ideally it'll turn out a lot better than this, but we want to underwrite conservatively. So we're expecting 30% for the next 2 quarters and then 10% for the following 2 quarters. So an average of about 20% rent collection loss. In rent growth, we were projecting 3.5% from the current rents, and now we're expecting to be the same, so 0. And additional income, we were counting on RUBS, so we're going to build back water. So that's pretty much out the window. So for the year 1 additional income, we're expecting 0. And seller credit, so initially it was just going to be April's prorated rent. So because we close it tomorrow, we would have gotten half of the April's rents. But because of COVID, we were able to negotiate $70,000 in seller credit, plus all of April's rent, which worked out to be $88,915. We just got that number today from our settlement statement. And because of the new market conditions, we're being even more conservative on our exit cap rate. So market C-class in El Paso is about 6.5 cap. And so our exit cap initially was 7.5. So now we're underwriting the exit at 8.5 cap. So a full 2 percentage points above the current cap rate.
Hey Duke, can you explain what does that mean? Like, what does a reversion cap rate mean?
Okay, so on the exit, the cap rate, typically, if you want to be a conservative underwriter, you want to add 1 percentage point to the current market cap rate. And it's kind of counterintuitive, but the higher the cap rate, the worse the market is. So we're assuming that when we exit, it's going to be a worse market than it is now. And the reason we do that is to protect against the downside, because if the deal still works at a worse market condition when we want to sell, then it will work a lot better if it's not worse. And I mean, it seems like right now it's pretty much as bad as it can get. So, you know, it's pretty unlikely that it's going to be, you know, a lot worse than now, but we still want to underwrite for that. So we want to plan for the worst. And so that the way it works with valuations is the higher the cap rate, the lower the value, assuming that the NOI is constant. So remember, the value in commercial is based on NOI divided by cap rate. So if you have a higher denominator, then you end up with a lower value. So same NOI divided by a higher cap rate leads to a lower sales price. So so that's kind of the thinking there. So so we've been underwriting at a 1% increase in the cap rate, which is the reversion cap rate. And now we're underwriting at 2 percentage points above the current market cap rate. So so that should give us enough cushion to be able to sell and still make the profit that we're expecting.
Cool.
All right, Steve.
Yeah, so just giving an update on the financing. And again, a little bit of a rehash if you were, if the investors were on the call, because we did cover this already previously, but definitely some changes. And this is, you know, some of this is due to just shopping around for lenders. Some of this is definitely due to market, you know, transitions due to COVID. So, you know, the old rate that we were working with our previous lender was at 4.75. And again, these are all great numbers. You know, which would typically be good for commercial. I mean, if we were to ask you even just a couple of years ago, this is good for residential, you know, but this is commercial, which is typically a point higher than percentage point higher than we would typically see in residential. So 4.75, already good, you know, interest rate, but we got an even better interest rate at 3.63. So just an outstanding rate for commercial. Interest only period. We did previously have 12 months of an IO period. With the new the lender that we ended up going with, they didn't give us any interest only period, and part of that is due to just the type of loan that it was, and also just due to the excellent interest rate. Amortization period with the old lender was 20 years, where the new one is 25 years. So again, just helping to lower the overall payment due to the stretched out term of the amortization period. And then something that was super significant to us was the LTV. So the loan to value with the previous lender was going to be 65%. That's what they ended up coming back with. And again, this is just a trend of lenders being just extra conservative, especially leaning into COVID. And you're going to see this more. Vince was alluding to this earlier, mentioned this earlier, where they're requiring more lender reserves pretty much across the board, for all new loans, on the commercial side. And this is also an extension of that too. This is more conservative on their side, where they want you to have more skin in the deal, more skin in the game at 65%. But the lender we ended up finalizing our loan terms with still gave us a 75%. So that right off the bat was excellent LTV. Loan term, again, 10 years versus 15 years with the new lender. And then this was also a significant one too, where having a prepay, we typically, you want to avoid a prepay if you can at all possibly do that. The previous lender did have a prepay, whereas our new lender did not, or does not. So again, overall, better lender term, better lending terms, which is really going to help to capitalize on the volatility of the market. But this is going to help us to have a much more stable, numbers moving forward. So.
All right. So Vince, why is not having a prepayment penalty good?
Oh, Vince stepped away.
Oh, okay. Well, Steve,
Well, yeah. So I mean, just in general, if there's a prepay in play, you're basically getting penalized. So if your whole term is going to be, let's say 3 years or 5 years or whatever the case may be, if you decide to sell, hey, you know what, year two, you know what, we've got somebody that's offering us an outstanding, offer where it makes sense to sell. Well, you know what, if there's going to be a prepay, at let's say 3 years, then you're going to get hit with a penalty. So it's definitely key. You always want to avoid having a prepay if at all possible, just to give yourself more options. So not having that prepay is definitely huge for us. So just gives you more flexibility overall to explore all options.
Cool.
Okay. And then, so why did we decide to move forward while some other people backed out during these uncertain times? Well, for one, it's our confidence in the business plan. So it's workforce housing, confidence in the El Paso market. So it's manufacturer based. It's a lot of diverse industries. And just based on the rent collections that the current property manager has been able to get, like it substantiates our confidence in the market. And then the biggest thing is the large amount of liquidity that we're getting at closing from the seller credit. So there's a big difference between getting a seller credit and a reduction in the price. So we had several rounds of negotiations, and in the first round negotiation, we had a reduction in price, which is good, but it's the loan amount kind of takes some of that already. So having a seller credit is good because it's just straight cash in our operating account. And that allows us to weather the storm. So having liquidity in excess of the reserves and the CapEx and all that is key for being able to sustain any downtimes or increased economic vacancy. And so the way that we kind of underwrote this next phase in deciding to move forward or not is by doing several stress tests. So when we're looking at our underwriting model, the market would have to worsen to over 10% exit. I think it was like closer to 11 cap rate for the project to lose money. which is huge because it's super unlikely that that would happen, that it would be like a 10 cap. And then the break-even point for economic occupancy is around 69%, or 33 of the 48 units paying, in order to maintain the debt service and operating budget. But of course, if this drops below that, we have liquidity to be able to carry the property forward. Okay, so the other part of that is how long can we cover all the expenses from the reserve account if the occupancy falls to a certain percentage? And by expenses, we mean just to run the property normally, like not like bare bones, but like the normal operations, and not including our CapEx. So CapEx is a separate account. And so with the reserves at 60% occupancy, we'd be able to cover 55 months of expenses for debt service plus operations. At 50% is 27 months, 40% is 18, 30% is 13, 20% is 11, 10% is 9, and 0% is 8. So, I mean, obviously it's never going to go down to like this low. But so it's good to know that even at 0%, we can still carry the property for 8 months. So, so that gives us confidence to be able to move forward, because we know that we have the liquidity to cover any losses that might come from this. So, all right. So yeah, that concludes our little presentation. So now it's just kind of open Q&A. So